In these tumultuous times of economic uncertainty, when anxiety haunts the financial markets like a specter, a single voice has emerged as a beacon of prudence amid the clamor for swift action. It is the voice of the Federal Reserve, steadfast in its commitment to taming the insidious dragon of inflation, even as its counterparts around the globe succumb to the siren call of rate cuts. The recent decision by the Fed to signal a more restrained approach to rate reductions this year has set it apart from its peers, who have already embarked upon a path of monetary easing. The Bank of Canada and the European Central Bank have taken the lead, lowering their respective benchmark rates in a preemptive strike against potential economic headwinds. Even the Swiss National Bank, that bastion of fiscal conservatism, has joined the fray, cutting rates in a move that would have been unthinkable just a few years ago. Yet, the Fed remains resolute, projecting a mere single rate cut for the year, a far cry from the 3 cuts it had anticipated just a few months prior. Its stance underscores a fundamental truth: the era of higher rates is here to stay, at least for the foreseeable future. This divergence from the global trend is not without consequence. As the Fed holds its ground, the allure of the mighty dollar grows ever stronger, luring foreign capital away from rival economies like a siren's song. Emerging markets, in particular, find themselves at the mercy of this gravitational force, their fortunes inextricably tied to the ebb and flow of the greenback. The ramifications of the Fed's steadfast stance extend far beyond the realm of currency fluctuations. It raises thorny questions about the potential for harmful volatility in foreign exchange markets and the risks it poses to the hard-won progress in reining in inflation, a battle that has consumed central banks around the world for the better part of a decade. As the financial pundits and economic soothsayers weigh in, a chorus of voices proclaims that the Fed's isolation is but a temporary aberration. The overall theme for Western, developed economies is that we're on the road to cuts, but it won't all happen at once, intones Christina Hooper, chief global market strategist at Invesco, her words carrying the weight of prophecy. The Fed is not in the lead this time. Last week was historic in that we saw 2 G7 central banks cut rates, neither of which was the Federal. Yet, the Fed's chairman, Jerome Powell, remains unmoved. His resolve is unwavering as the granite foundations upon which the institution stands. In the aftermath of the latest policy meeting, where rates were left untouched, Powell's words carried a stern rebuke to those clamoring for immediate action. We've stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. It is a stance that has drawn both praise and censure, with the financial world divided between those who laud the Fed's prudence and those who decry its reticence as a missed opportunity to stimulate economic growth. But amidst the cacophony of opinions, a voice of reason emerges. Tiff Macklem, the esteemed governor of the Bank of Canada, offers a measured perspective. There are limits to that divergence in interest rates, but we're not close to that limit. His words carry the weight of experience, a recognition that the path to economic stability is rarely a straight line, but rather a winding road fraught with unexpected twists and turns. For now, the Fed's contrarian stance has only served to reinforce the prevailing trend that has taken hold of currency markets in this tumultuous year of 2024. The siren song of high relative yields in the United States has proven too alluring to resist, a clarion call that has drawn investors from around the globe to the safety and stability of American assets, and by extension, the dollar itself. The evidence is writ large across the financial landscape. The euro, that once proud standard-bearer of European unity, has shed more than 2% of its value against the greenback. The Canadian dollar and Swedish krona have fared even worse, weakening by over 3% in the face of the dollar's inexorable advance. And the Swiss franc, that traditional bastion of strength and stability, has lost nearly 6% of its value, a humbling reminder of the shifting tides of global finance. Even the Japanese yen, that stalwart of the Asian markets, has not been spared, succumbing to selling pressure in the wake of the Bank of Japan's decision to stay the course on monetary policy. The central bank's announcement that it would specify its plan for bond purchases at a future meeting only served to fuel the yen's decline, as investors braced for potential cuts to debt-buying programs. This relentless dollar buying, fueled by the relative yield and growth advantages of the United States, has been a global phenomenon, transcending the boundaries of time zones and geographic borders. A recent study by Bank of America currency strategists Howard Dew and Vadim Iralov revealed a startling truth: much of the dollar's ascent has taken place outside of U.S. trading hours, driven by investors in Europe and Asia, drawn inexorably to the siren song of American exceptionalism. You have a central bank dynamic where the Fed relative to most other global central banks is perceived to be more hawkish, observes Nathan Thuft of Manulife Investment Management, his words carrying the weight of seasoned analysis. Eventually, the Fed will begin a cutting cycle like everyone else, but our relative rates are starting at a higher level, and we're starting later. Even if the Fed does eventually succumb to the pressures of easing, the moves are likely to be measured and restrained, a far cry from the aggressive rate cuts that have characterized past economic cycles. For as Jerome Hageli, chief economist at Swiss Re and a former official at Switzerland's central bank, sagely notes, what the market's short-term thinking misses is the fact that the Fed is likely to cut by much less than what was previously the norm. Higher for longer remains intact in the US and over time. The markets, ever fickle and prone to short-term thinking, have already begun to price in the possibility of a Fed rate cut as early as September, buoyed by the recent release of a key gauge of underlying inflation that posted its smallest annual advance in more than 3 years. Yet, this optimism may prove to be short-lived, for as Hageli warns, the Fed's commitment to higher rates is likely to endure, a bulwark against the resurgence of inflationary pressures that have plagued the global economy for far too long. Moreover, the path to monetary easing is far from certain for the Fed's counterparts around the globe. The European Central Bank, for all its recent boldness in cutting rates, now faces a stern warning from one of its own governing council members, Joachim Nagel. Central banks on both sides of the Atlantic have to be even more stubborn than the inflation. His words echo those of Macklem, underscoring the common challenge that binds central bankers across the continents, a shared struggle against the insidious threat of rising prices. And the Fed is not alone in its hawkish leanings. The Bank of Japan, long a bastion of ultra-loose monetary policy, now finds itself under mounting pressure to tighten its stance, as the yen's prolonged weakness threatens to undermine the nation's economic stability. Even the Reserve Bank of Australia, once a vocal advocate of rate cuts, now strikes a more cautious tone, warning of ongoing price pressures that could derail the fragile recovery. Of course, the other risk is cutting too soon, with inflation picking up again, and rate cuts having to be reversed, cautions Salida Marcelli, Chief Investment Officer for the Americas at UBS Global Wealth Management. Which is precisely why the Fed has been very patient in starting its easing cycle. In this climate of uncertainty, where the forces of inflation and economic stagnation vie for dominance, the Fed's patient approach stands as a beacon of rationality, a bulwark against the impulsive urge to pursue short-term gains at the expense of long-term stability. For it is a truth as old as the hills that easy money, while offering temporary respite, often sows the seeds of future turmoil. History is replete with cautionary tales of nations that succumb to the allure of cheap credit, only to find themselves mired in the quagmire of runaway inflation and economic stagnation. The Fed, it seems, has learned from the mistakes of the past, eschewing the siren call of immediate gratification in favor of a more measured, far-sighted approach. For Jerome Powell and his colleagues understand that the path to true economic prosperity is not paved with quick fixes and short-term bandages, but rather with the arduous labor of foresight, discipline, and an unwavering commitment to the long-term health of the nation's financial system. In this regard, the Fed stands apart from its global counterparts, a lonely voice of restraint amidst a clamor for swift action. While others may succumb to the temptation of monetary easing, the Fed remains steadfast, its gaze fixed firmly on the horizon, ever mindful of the dangers that lie in wait for those who stray from the path of prudence. It is a stance that has drawn both admiration and scorn, with the financial world divided between those who laud the Fed's wisdom and those who decry its supposed inflexibility. Yet, in this great debate, one cannot help but be reminded of the timeless adage, prudence is the virtue by which we discern what is proper to do under various circumstances in time and place. For prudence, that oft-maligned virtue, is not merely a matter of caution or timidity, but rather a judicious weighing of risks and rewards, a careful consideration of the long-term consequences of our actions. It is a quality that has been sorely lacking in the annals of economic policymaking, where the siren song of short-term gains has all too often drowned out the voice of reason. The Fed, it seems, has embraced prudence as its guiding light, a beacon that illuminates the path forward in these uncertain times. And while its stance may invite criticism from those who crave immediate gratification, those with a longer view cannot help but admire the institution's steadfast resolve. For in the end, it is not the fleeting applause of the moment that matters, but rather the enduring legacy of responsible stewardship. And in this regard, the Fed's lonely voice of restraint may well echo through the ages as a shining example of principled leadership in the face of adversity. As the world watches with bated breath, the Fed's path forward is sure to be fraught with challenges and uncertainties. The siren call of easy money will continue to beckon, its allure amplified by the chorus of voices clamoring for swift action. Yet, if history is any guide, it is those who resist this temptation, those who embrace the virtues of prudence and foresight, who will ultimately emerge victorious in the eternal struggle for economic stability. In this great drama, the Fed has cast itself in the role of the stalwart guardian, a bulwark against the tides of impulsivity and short-termism that have so often swept away the foundations of financial well-being. It is a mantle that carries with it an immense burden of responsibility, a weight that would buckle the knees of lesser institutions. But the Fed, it seems, is made of sterner stuff, its resolve forged in the crucible of past crises and its wisdom honed by the harsh lessons of history. For it understands that true economic prosperity is not a fleeting moment of respite, but rather a long and arduous journey, one that demands unwavering commitment, disciplined foresight, and an abiding faith in the power of prudence. And so, as the world watches and waits, the Fed stands tall, a solitary figure upon the economic landscape, its gaze fixed firmly on the horizon, its resolve unshaken by the clamor of the moment. For in these uncertain times, it is the voice of restraint, the clarion call of prudence, that may well prove to be our surest guide through the storm.